Hi, Lance Roberts here for the Lance Roberts Show podcast at realinvestmentadvice.com. Make sure you buy our YouTube channel, Lance Roberts Show, to get all of our updates, all of our videos with great interviews from David Grocke to Chris Martenson to a whole variety, Larry Lepard and more, all at the website. You'll find them there, lancerobertsshow.com, and on our podcast page at realinvestmentadvice.com. I want to talk about the markets here specifically because the markets are sending some warning signs. We've been talking about over the last couple of weeks several things, looking at the fact that a lot of the tailwinds that have supported the market over the course of the last decade have now shifted to being more headwinds. We have less liquidity. The market, the Federal Reserve is extracting $50 billion a month out of the markets. Interest rates are rising. Stock buybacks are slowing. Tax cuts are fading their efficacy at this point because tax cuts are good for about 1 year, and then we get back to year-over-year growth changes in earnings. So the tax cut benefit goes away very quickly. That's all starting to weigh on the outlook for markets, but it's not just those factors domestically, it's also the global markets as well. Let's take a look at what's happening specifically with markets really all around the world. This chart is the S&P 500. This is our large cap index. And of course, what's interesting here is that this decline that we've been in here since October really mirrors a lot of what we saw back in early February of this year. Same type of initial decline, an initial bounce, a retest of lows. That's potentially still going to come here, but the difference this time is the fact that the markets are violating really important trend lines. This is the 50-day moving average, and historically the market has traded in, when you're in a bull market, trades above the 50-day moving average. Bear markets occur when you trade below the 50-day moving average, and importantly, we have not only violated the 50-day, but we have now also violated the 200-day moving average and are trading below that as well, and that is a difference that we did not see back in February of this year. The 200-day moving average acted as support. That remained a strong trend line going all the way back to the 2016 period where we initially went through that bear market back then. That bear market in 2016 was bailed out by the central banks, really globally. The ECB as well as the Bank of England all came in with their own version of QE to really support the markets against a potential Brexit issue. That has not been the case here with the S&P 500. Central banks have not shown up to the rescue. Interest rates are still going up, and Jerome Powell with the Federal Reserve has no intention at this point of stopping his expansion of interest rates and the reduction in the Fed balance sheet. But it's not just the S&P. It's not just the large cap stocks that are being impacted currently. It's also, take a look at small caps. This is a small cap 600 index. This is the smallest 600 companies in the S&P 500. Again, we see the 50-day moving average has turned lower as the market has declined, and also importantly, violated here the 200-day moving average. And again, the difference this time is, going all the way back to 2016, the market has rallied up to and have now failed at the 200-day moving average. Now, small caps are very impacted, I should say, by things like tariffs and trade wars. They are the most impacted by changes to the economic environment. Same thing that we see in the mid-cap stocks. So this is the mid-cap 400 index. This is the middle-sized 400 stocks within the S&P universe. And again, what we see here is the same thing. The 50-day moving average is now coming down to actually touch on and potentially set to cross the 200-day moving average. And again, this suggests that in the mid-cap index, you're seeing much more downward pressure in that area. Of course, these companies are very economically sensitive. But again, these are all part and parcel of what we're seeing across the broad spectrum of the U.S. economy. But this is really a latency effect at this point of what's happening globally. We've talked about the strength of the economy here because of tax cuts, low interest rates, and of course we've had this expanding economic environment, but that has not been the case globally. Let's take a look at the global index. This is the MSCI All World Index. This is every country in the world except the U.S. And what you see here is a much more protracted bear market decline in their markets currently. And again, not only do you see the 50-day crossing well below the 200-day, The MSCI All World Index is now tracking that decline in that index and that moving average to the downside here. So a very big downtrend in the world market, suggestive of a much weaker global economic environment. And this is something that we're now seeing come back home to roost here domestically. While it's believed that the U.S. can remain kind of an island unto itself and that, really the rest of the world can decouple from the U.S., the reality is that 40% of corporate profits are driven by what we export to other countries. A stronger dollar, higher interest rates, and of course, economic weakness globally is going to impact the U.S. And we're already starting to see that show up in corporate earnings. Forward estimates on corporate earnings are coming down. We're down $10 on 2019 estimates already, and that's going to go lower. And we're already seeing concerns from U.S. companies in the recent earnings reports about the impact of tariffs and trade wars and what's happening with the global consumer as well. This is China. This is one of our major trading partners. This is the Chinese Shanghai Composite Index. This market has been in a major downtrend and is down 50% from its highs back in 2015. So again, despite an economy that's been driven by a lot of credit impulse, you have entire cities that are being built that nobody lives in, the markets have already picked up that there's substantially something wrong going on within the Chinese economy. Again, that is something that's going to be reflective back here in the United States as well. So, and again, as we talk about all of these things, and particularly when you're looking at the markets as a whole, economic data is subject to severe backward revisions. Every year, the Bureau of Economic Analysis revises their data backwards over the last year, and every 3 years, they do a major revision of their data over the past several years. And what we're likely going to see is negative revisions to current economic data, and the market has already been picking up on the weakness here already. So again, don't dismiss what the market message is trying to send you. They are telling us that there's something changing within the global economic environment and the domestic environment as well. Rising interest rates are a drag on economic growth, and we're already starting to see some of that impact coming into some of the recent earnings reports and more. So keep a watch out here, protect your assets, and make sure that you understand what's happening with the markets. If you have any questions at all, get by the website, realinvestmentadvice.com. Click on the Ask a Question button. We'd be happy to help you. And again, as always, thanks for watching us here at The Lance Roberts Show. Simply go by our YouTube channel, Lance Roberts Show on YouTube, or on our website at the podcast page. All of it's there for you, and we'll see you next time on the next edition of The Lance Roberts Show podcast.